Hi, Chris. How are you? Thanks for joining us today.
Great to be here.
Yeah, thanks, Chris.
For the listeners at home, Chris is the founder of Cut Through Venture. We've had Chris on before, and we're going to go through to today's Q3 2024 report that's just been released. This isn't a substitute for actually going through the report, so we're going to assume either it's read or is going to be read and just call out a few key bits. I think one of the big ones is that some of the media attention has been that total funding is down, and that is definitely one message, but number of deals is up. And I think that's actually a good thing. What did you take away from the data, Chris?
Yeah, look, the headline number in terms of funding gets influenced by a couple of deals in any given quarter. And so when we first started Cut Through, we were doing a monthly readout, and that was during the boom period of 21. And there were in some months 150 deals getting announced. But even then, the months where there was an Airwallex deal or a Canva deal announced, those were the boom months. I think now that we've moved to a quarterly, that is a little smoother. But if you look at last quarter, so Q2, it was a real bounce back in the total funding, but that was driven by a handful of very large deals. And this quarter, I should say, those just weren't there. So there were no deals over $100 million announced. There was only a very small handful over 50. And as a result, that big headline number that people do get excited about, and we probably promote and cause part of that excitement, that wasn't as exciting this time around. As though total number of deals was really strong, particularly at the early stage. You had 3 big syndicates and accelerators announce cohorts. So that played a big part in the lower check size deals. But then you also had from pre-seed and seed a ton of volume from a deals closing perspective, and then all the way through Series A, B, C. And there were, as I mentioned, a couple of later stage deals as well, albeit smaller. So I think just generally, at the end of the day, companies going out to raise will raise what they need to raise. Hopefully they can raise what they need to raise. And if it is for whatever reason that they're not raising as much, then I don't see that as necessarily a negative. As long as deals are getting done, companies are getting funded to push towards that next raise, that's what we want to see.
Yeah, I think it was really positive. And picking up on something you said there about the number of accelerator rounds, I think there were 39 quoted for the quarter. And it's good to see that uptick. Is that something you'll track more in the future? Like the outcomes or tracking against the companies coming out of accelerators or other programs?
Yeah, it's an interesting one. So we've always tracked accelerator deals. We did break them out explicitly this time around just because it was such a large number. As you pointed out, 39. You had StartMate, of course, who have got their demo day this week, and Techstars, and then a couple of specialist accelerators, and actually a couple of Australian startups that raised or were part of overseas accelerators as well. So we've always gathered that information, and we do have an ability, obviously, to track how many of those progress on to a seed round and further. It's well documented and covered in the press that StartMate has had some really great success. They've been around for long enough for those opportunities to bake. I think my observation in working with the different accelerators in various capacities across the board is that the companies that are participating in these programs are, in most circumstances, very, very early. And so I would say that where the time to look at them and say, well, have they successfully moved to the next round is still like a 18-month to 2-year period. Some of them do raise in parallel to participating in those programs, but it is a bit of a 2-year lag time. And if you look at the current ecosystem of accelerators in this country, StartMate's really the one that's been around for long enough to look at that data. And we have good lines of communication with Techstars and StartMate and some of those other more niche ones to try and track those companies, because it is really important. There is undoubtedly a debate about the value of accelerators. I'm a fan. I think that they can be done poorly, but I think those two in particular that I've mentioned do a good job. But Techstars only launched last year. StartMate, the results have spoken for themselves, but it is certainly something that we track and will look to report on in different ways going forward. But we do a section in our big annual report on accelerators and are working with those programs to find ways to not just give them a shout out in the report, but actually be more data driven in how we report it, the success or not success of different businesses that come through the programs.
I was having a discussion with a potential company out of Europe last week, and I said, well, you're going to have to MacGyver it. And they looked at me a little bit stupid. I said, MacGyver, the guy that made a helicopter out of an avocado, a 9 and a steel rule. That's what I guess we're starting to see a bit more of, where founders are learning to properly MacGyver, do more, but with less, leading less on cash and resources. I know it probably doesn't stand out in the data, but are you seeing that just as an investor, as a general mindset that's changing?
I would say Australian founders are famous for that. I've seen stats. It's probably in one of your charts. It's not as reliable as the sort of stats that we report on, but I have seen stats and commentary to say that Australian startups are some of the fastest to reach $1 million ARR. They are slower than the US companies to reach 10, but they are quick to ARR, and they do it to $1 million of ARR, and they do that with less investment. I think by virtue of the ecosystem still being very small from a funding option perspective, it's been through necessity. I think particularly at the early stage, there still is a bit of a gap in the market for Australian VCs that are willing to invest in pre-revenue, true pre-seed deals. And so companies are having to start bringing in their first customers before turning to venture. I think as you get later, we, in our portfolio at 5V, a lot of the companies that we have backed recently have in fact never raised before. We're a Series A investor. So they've had to, in many instances, survive the last 2 years, having not been able to get away a traditional seed round because they missed that window that sort of closed at the end of 2021. And so they've figured out a way to bootstrap their way to several millions of dollars of ARR without external funding. That is pretty rare when you think about the type of businesses that get viewed as venture backable in the US. I think it is something that a muscle that Australian founders have. It has been through necessity, but I think as we sit here today, there are funds that sort of step in at the seed, which is great, but definitely getting through that very, very early phase of getting the first few customers in the door. Aussie founders are world-class, in my opinion, of scrapping their way to do that, which is a great thing. So it's a feature of the founders that we produce, and I don't see that changing. I think it's less likely that we're going to start having very, very early pre-seed investors enter in the immediate term. So I think, it's a feature of founders that we should be. It opens up good opportunities like for yourselves and for 5V a little bit later to back companies that have very simple cap tables, haven't overraised, haven't had to fighting gravity in terms of big valuations that they've raised at a pre-seed or seed.
And Chris, just to tie it back to founders, what are some of the key insights from the report this quarter about the state of the market?
Look, I think one of the things that we do is we do an investor sentiment survey. So for our annual report that we put out, we do survey founders and we survey angel investors as well. For these quarterly reports, we do just survey around 300 professional investors in startups. I would say generally sentiment in terms of how investors feel about the state of the market is definitely on the rise. It's been on the rise all year and continuously just ticks above. We measure that sentiment by just asking that question, how do you feel about the state of the market? But we also ask them about the level of activity that their fund is seeing and the level of activity that they expect their fund to see. And you would think, investors are always going to talk themselves up and say, we're feeling really good about our opportunity set. But that definitely wasn't the case at the end of last year. And so sentiment from an investor perspective is definitely on the rise. Confidence in being able to deploy capital into the market and into new opportunities is definitely up. And the focus area for investors has also shifted. If you look back this time last year, the focus was all about looking after the portfolio, making sure that the current companies that they're invested in don't implode. And that has definitely shifted down the ranking of where investors are spending their time. Investors now are doing their job again, which is to invest in new companies, which is great. I think One of the things that did come through though in the survey, and look, it's a survey, so it's not perfect, but it does seem that layoffs and company shutdowns are continuing. It is part of a startup ecosystem. The press does latch on to things like startups having to let go of people or sometimes shut their doors. That is a reality of the space that we're investing in, but that certainly seems to be elevated versus what we saw during the doom time era where capital was much easier to come by.
Yeah, shutdowns seem to be elevated, but what's also elevated, it seems, is investors and founders seeking exits.
Yeah.
Through the M&A channel. It really seems to have picked up a bit, and your report talks about, I think the exact words are we entering exit season? Is that something you've seen in previous ones, or has this really come out of the gates hard this quarter?
Look, I think if you think about the different players and their incentives, so you've got investors who are looking to deliver returns to their LPs. You've got a number of funds that have come up against that come to the end of their life cycle, so that 10-year holding period where they do need to exit, so that is one element. You've got funds that maybe made a number of investments during the 2020 and 21 era that were aggressively priced, and maybe the businesses, it's become clear for whatever reason that the business is not going to be the next Canva, but they want to find ways to deliver some returns back to their LP base. So I think from an investor standpoint, there's a whole bunch of factors as to why things like secondaries and sell downs of their stake have become more popular. I think from a founder's perspective, what we're seeing is, and in discussions that I'm having with other investors and with founders that we know through our network, is that if you think about a venture portfolio, there is this power law where there's going to be one or two investments in every fund that really hopefully return the fund, but definitely return outsized return relative to everyone else. You're going to have at the other end of the spectrum a bunch of companies that don't make it. But then you've got this middle of really great companies that have reached some level of scale, but they've just hit a bit of a wall in terms of delivering those 100% or thereabout venture style returns that are still growing at 50% or 40%, which for any other investor would be a great return. And so what we're seeing is a lot of demand from private equity, some less traditional funds, family offices, or strategics, so other larger companies within the same space that are looking to these businesses that maybe have fallen out of favor of the traditional venture investor and saying, hey, this is still a great business. It's doing $15 million of ARR. It's growing at 30, 40% a year. Let's take that under our wing and support the team to continue to grow it at that rate. So we're seeing more and more of that. We're hearing more and more of that. You're seeing it in the paper more of these sort of outcomes that are not billion-dollar outcomes necessarily, but in some instances, several $100 million outcomes. So not necessarily going to return the fund for venture investors, but provide a really great outcome for the founders, the employees, the early angels, and provide a reasonable outcome for venture capitalists, which is far better than the zero outcome.
I think you guys were in vendor panel, weren't you? Yeah, that was announced last week. We were in that as well. We were late to the party, but early investors did really well out of that. But an opportunity came for them to merge with another business and create something of significant scale. And it's sad to lose a good business out of the portfolio, but you do need that middle of the road return, as you point out, in order to make economics work.
Yeah, absolutely. And look, that team is awesome, amazing founder who we would have happily continued to support as a standalone business. But at the end of the day, I think you've said it, Don, with respect to this opportunity, at the end of the day, you need to back the founder. And I think they have a far better understanding of what the most likely pathway of longer term success for the business is than us. And so we're very happy for the team. It was a good outcome for us. It was a good outcome for our investors. And yeah, we move on.
Yeah, a great outcome for the team. But I really like this part of the report this time, the exit season, and how you broke down the most common around secondaries through the PE kind of stack into listings.
Yeah, look, that was again survey. So we try and dig into one topic in particular with each of the quarterlies. Last quarter, we looked at AI and how Australian investors were thinking about the AI space. Obviously, super sexy at the moment. Look, it was the thing. We get pulled in the direction. So a lot of people are talking about exits. Every conference has big chunks of the programming is about exits. There were some people far more experienced than me saying what I was thinking. And so we use that as inspiration to dig in a little deeper. And we have this great cooperative of VCs that are willing to answer our surveys. So we feel like we can get some good insights that are useful for the ecosystem. So that's how we do that. So it's very much whatever's the flavor of the month when the quarterly report comes up, we try and support that or challenge the assumptions around those topics with data.
I'm curious, is this kind of rise of secondaries, is this a new normal to drive increased liquidity in the venture space? And if so, how do you see that playing out for long-term returns of funds, like that early DPI affecting the long-term gains?
Well, yeah, so friends of ours, second quarter, are a great partner or supporter of the ecosystem in terms of being the first mover as a dedicated fund playing into that space. I think my understanding is that they are flooded with more opportunities than they can handle. There are a lot of secondary vehicles overseas, out of the US, Europe, and Asia that are chasing after that top echelon of Aussie startups and scale ups that have cracked that unicorn status or $100 million of revenue. Demand for secondaries in those top companies is definitely pretty strong. And so what I would love to see, and I'm sure the second quarter, again, I have no information, but I do hope that the second quarter team are able to, when they raise their next fund, it's even bigger because the opportunity set's huge. You're seeing also a lot of these new funds that are positioning themselves as growth funds come to market, both from the private equity side and the venture side. So the venture side pushing up and the private equity side coming down. 5Vs is one of those funds. We've launched a fund called our Frontier Fund, which will be a mix of technology companies and non-technology companies that are what you would usually have traditionally thought of as being more venture, late-stage venture companies. You saw Quadrant Private Equity come out with a growth fund and came out swinging with their big $500 million chunk of Canva secondary that they bought. You got EVP come out with the growth fund. They're a great investor and friends of ours. OAF has a opportunities fund. And then, of course, Squarepeg, Blackbird, and Airtree all have funds that are much larger and able to either buy positions off prior funds of theirs that are coming towards the end of their life, but also invest in new opportunities at a much larger scale. So I think you talk about exits, and maybe to someone that's not in our space, you assume that means that the entire company is IPOing or being acquired. But the reality is that we are along as investors. We're along for part of the journey of the company, and if it so happens that a full exit of the company times with our ownership, then that's fine. But I think the fact that these secondary options exist means that as investors, we don't need to force an outcome on founders that they may not want yet. So I do think it's a really great thematic that's playing out. And if there's one part of the ecosystem that I can almost certainly say would be growing over the next few years, it would be that secondary or later stage growth fund part of the market.
It's at the bigger end of town, but I assume everyone at Quadrant is going to have to find some new restaurants to eat at, given losing the restaurant portfolio. But I think the relevance to our end, in previous reports, you've had some stuff there about the venture credit market and venture debt. Are you seeing anything where companies that got venture credit in those boom times that maybe shouldn't have, or maybe they just haven't hit targets or whatever it is, where the lenders are going to have to start to step in, a bit like what Quadrant's had with their restaurant portfolio?
Yeah, so very different set of circumstances as it relates to a private equity style investment. But look, all I can say is that we know the companies in our portfolio that have taken on venture debt. I think I spoke about it last time. We think that there's a time and place for venture debt. We don't think it should be a funding source of last resort. I think that's the key point. In instances where it is being used as a funding source of last resort, you're taking a punt, basically. You're taking a venture style punt or even a binary flip of the coin that the company is going to be able to grow into being able to service that debt. The types of businesses that we back that have taken on venture debt were definitely not in that bucket. And I also think that the majority of, all the funds that I know on the venture debt side that are investing from a debt perspective into startups are pretty responsible. There are absolutely some cowboys out there, just like there are cowboys in any area of finance. But if you look at one end of the spectrum, like Attractive Ventures, making very small early stage working capital facilities available, super responsible. And my understanding is that the book is holding up well. There's another business, Fundable, who just rebranded themselves as Mighty. They're in a very similar space. I don't think I'd be in trouble for saying that they've never had a deal go under. It's very important for them at that early stage. They are startups themselves, and the loan book it's very important that they don't start to show losses. And so they are spending a lot of time diligencing businesses. At the other end of the spectrum, you've got larger investment banks and banks. HSBC, who's a sponsor of ours, is in the venture space at the larger end of town. One Ventures has been around forever. They invest venture debt alongside venture capital, and they're, again, all just conversations that I'm having with them, they're all feeling very comfortable. But look, there's definitely cowboys out there that would have lent to businesses that maybe shouldn't have been lent to and charged them excessive fees and interest. And I suspect that there will be bad outcomes for those players, but there'll also be some good outcomes because, as I said, it's a flip of a coin. And but I'm positive about venture debt. I think it's an important tool that can be used by founders in the right way if it's used correctly, but just certainly not as a last resort alternative to VC funding.
No, really, really good point. Aaron or Jack, anything else your end?
No, that's
That was my end. That was a good chat.
Oh, that's good. Well, Chris, we'll point everyone to the report. For those that haven't downloaded it, please do. And also sign up, because I know as time goes, the more people that contribute to the report and the data, the better that data is going to be. So thank you again for catching up with us and sharing some of those deeper insights.
Always a pleasure, guys. Good to see you.
Cheers. Thanks, Chris.
Thanks, Chris.